Welcome to another edition of Real Talk. One of the areas within real estate transactions that has kept us quite busy is on the real estate debt fund formation side, working with real estate debt funds as lenders counsel. Ever since the GFC, the number of debt funds have increased significantly. And as we're in a challenging market right now, a challenging liquidity market, debt funds are getting more and more active. And so that's why I wanted to have Jan Brzeski on the show. Jan was one of the founders of Arixa Capital, who's put out up to $5 billion in lower middle market loan amounts. And he has also since left Arixa to start another debt fund called Sage Credit Investment Partners. I think you'll enjoy my conversation with Jan. We talk about the debt market. We talk about how he hopes that his company can provide much needed financing to builders in both the Palisades and Altadena fire areas, and how he views where the debt markets are going in this economy. I hope you enjoyed my conversation with Jan Brzeski.
Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Hello, welcome to another edition of Real Talk. I'm here with my good friend, Jan Brzeski. Jan, how you doing?
Great to see you, Andrew. It's been a while, but it's great to see you in person.
I know, it really is. And it's great to have this podcast in person. We do so many virtual, but it's nice. Look, face-to-face is always the best communication platform.
Well, and I wanted to come in person because I owe you a thank you, as you know, because many years ago you introduced me to Greg Hebner, who became my partner, who was a great partner to have through one of your events that you were hosting at your prior law firm, I think, right?
Yeah, gosh, it's like the whole world is divided into two: pre-COVID, post-COVID, and now it's going to be pre-fire, post-fire. But pre-COVID, we had a lot of events. Monthly gatherings, cocktails, breakfast. We are in the process of moving offices. We're currently, or have been in Century City since the firm opened about 10, 12 years ago. But we'll be moving to Sawtell in the summer, which will be a much more creative office, high ceilings, a lot of open space, balconies, and it'll lend itself to a lot more gatherings, and we could go straight into some unbelievable sushi restaurants on Sawtell.
Put me on the invite list. I want to come to your events, and I'll invite you if we do an event as well.
I love it. Please. So Jan, you founded Sage Credit Investment Partners, but before we get into what you're doing now, tell my audience just a little bit about yourself and your background.
Yeah, so I started in the real estate industry in 2002, working for a guy named Sam Freshman.
Sure.
Who was
I remember
the book is somewhere here. Yep, he gave it out a lot. He was a great teacher about real estate investing, and then during the financial crisis.
I hate to ask this, by the way. Is he still alive?
He is.
Okay.
He is. He's not active in his business anymore, but his business remains, I think, family owned. And I learned a lot from Sam, including how to make loans as a real estate investment, because during the financial crisis, he wanted to use his capacity and line of credit to make loans to other real estate investors that were doing opportunistic acquisitions during the crisis. So that was the first time the light went off in my head of, wow, a loan can be an investment. You don't have to buy the property. You can lend on the property. And then fast forward a little bit, and I met Trixie Weiss from Genesis Capital and ended up buying some loans from her to test out what kind of what the returns would be and how that business model worked. And I had wanted to start a fund and build a track record as a portfolio manager. So these loans on single family homes that investors were buying and renovating, that turned out to be the best way for me to get my first fund started. And that was back in 2009, 2010 that I launched the fund.
Yeah, a challenging market, or maybe a great time for you because there wasn't a lot of liquidity in the more traditional credit market.
Yeah, it was a fortunate time to start doing that because there weren't a lot of people making those kinds of loans, and the loans were safe and they had pretty good returns. The other thing that was good about it was, we were able to fully invest and then exit the investment all within a year, typically even less. And back then it was sort of 6 months until payoff typically. So that was great for building a track record because I wanted to be able to show investors, look, if you invest with our fund, you're going to be able to get returns. And I can prove to you that we've exited a series of transactions successfully with positive results. Whereas if I'd gone and done something more like syndicating a value add apartment project, which my skill set didn't lend itself to very well anyway, it would take probably 5 or 6 years to go through an entire investment and have a sale to be able to prove that you made money. So it was a niche that I leaned into, and I think that's my calling, and maybe the one thing I found in my career that I really, really enjoy doing, and I'm also good at it. It's a match for me.
Yeah. So for over a decade plus, you were with Arixa that you founded, which around Los Angeles, I would say was one of the leading bridge lenders in the space that lower middle market loan amounts is known as the most prolific lender in that space. So I know you met your partner in my office at one of those gatherings, but just talk about the early stages of Arixa and what you and how you grew it.
So I started Arixa in 2006, and I was still working with Sam, but as a contractor, not an employee anymore.
Yeah.
And we started the first fund in 2010, doing these loans. And then I met Greg through you, I think around 2012. And I had this little lending fund that had been going a couple of years. I started lending to Greg, who was actively rehabbing houses after the financial crisis, buying and rehabbing them. And he and I decided to partner up to do a fund that was going to buy houses, renovate them, and rent them out, and sort of try to ride the market back up after the financial crisis. So that's why we originally partnered, actually. And I fairly quickly realized he would be a great partner on the lending side as well. And so we ended up raising money. We partnered with another pretty high profile partner to do higher end homes, kind of like the $3 to $5 to $7 million loans per house. And that helped us launch ourselves into the market a little bit in a more substantial way because we had more capacity to make loans with his investor network and his own capital. And that was called Crosswind Financial. And really the story of Arixa was just try to make every year a little better than the year before, just try to serve our existing clients, keep them happy and have them come back. And by the way, you mentioned Arixa was, a prominent lender. Arixa is even more so now. I stepped back about 2 years ago because for family reasons, my wife and I wanted to move to North Carolina, and we did that. And Greg put together a group to let me really step back in the business and sell most of my equity, but I'm still a passive minority owner. I'm not involved in management anymore. And he's leading the business, and it's gone on to growth. They funded $3.5 billion or so at the time that I left, and had been running the business to that point, and now they're above $5 billion. So
Incredible.
They've done a good job, and we were able to raise capital from a lot of different sources. And there's a need in the lower middle market. There's an absence of real professionalism, and you don't get the same level of responsiveness and professionalism that you would get from on a $30 or $40 million bridge loan. Of course, everyone would expect their lender to be super professional, but on the $1 million bridge loans, that's not always true. And so that's really, I think, the formula that we brought was, let's do everything as if this is a $20 million loan, even though it's a $1 million loan.
Now, when you are providing loans at that level, I assume it's all about volume. How do you have the manpower to originate that number of loans, to service that number of loans, to deal with that number of borrowers? how big did Arixa get in terms of people?
Well, I think Arixa today is somewhere between 50 and 100 people, maybe similar to your firm, and I'm guessing, right?
Sure.
And you're right. It does take a lot of people to do this business when you have a lot of small loans that pay off fairly quickly, and most of them have construction draws, which means that you're funding multiple times during the course of the loan before payoff. So it's really about hiring the right people who have a passion for this and training them about our what's our kind of like the way that we want to approach the business, the way we want to treat our clients, the way we want to be a fiduciary to our investors. And it's not the business to do if you want to build something to 30 billion of AUM. You know, I don't know if that's not possible when you're doing small loans, but you can certainly get to reasonable scale. And I think the key is you have to enjoy the process, because you're not really aiming for any particular end result. At least I never have been. There are people that built businesses where their goal is to scale it and sell it. And there have been buyers for these types of businesses in the past, but I always just enjoy the business itself and being able to go out and see incredibly talented borrowers and kind of play a small role in their success.
So you started Sage Capital. Talk about that company. What are you focusing on? The types of loans, the types of properties.
So we moved to Durham, North Carolina about a year and a half ago, and I had stepped back from Arixa and I sort of just focused on some family stuff for several months and getting acclimated to living there, which I really enjoyed. It's a great part of the country.
Yeah, I actually spent a pre-college program between my junior and senior year of high school at Duke. At Durham. I wanted to play baseball at Duke. I loved Bobby Hurley and Christian Laettner in the early 90s.
Yeah.
And what an amazing place.
Well,
I ended up at Northwestern.
And UNC is there as well, and NC State. I mean, it's Raleigh is the capital of North Carolina. So I love being back there, and I quickly realized I've got to have purpose, right? I've got to get back to work. And I thought about doing some things that would be a little different from what my background would be, because I would have preferred in some ways to not overlap at all with what Arixa was doing, because I'm very close to the team there. I'm super excited about where Arixa is going. But I came to the conclusion that some of the things I wanted to do, I couldn't raise the capital for with a low enough cost of capital. For example, I would have loved to be making buying senior participations in other lenders' loans, but the returns are lower, and you just can't raise capital.
You're essentially buying A notes.
Yeah. I mean, there's a need for that in the industry, but you can only pay your investors probably 7 or 8%, and there's no way to raise capital at a 7 or 8% return in private credit today. There's too many people offering 9 or 10 or whatever, even 11, and so I came to the conclusion, let's just do what I know how to do and find the borrowers in North Carolina that need that. So I found some great borrowers early on, which is fortunate. And I was able to make some loans using my own resources initially. And
so you funded your own loans?
I did. Yeah. I personally, I don't know any better way to invest my own money than doing what we do professionally, what we did at Arixa and what I'm doing at Sage Credit now as well. And I just love everything about it. I don't know how else to say it. It's a great investment, and everybody can win at the same time. The borrowers, they're paying a little higher rate than banks, but also if they're good at what they do, there's plenty of profit in it for them as well, even after paying slightly higher rates to their lender. So, so I started doing it there, and then we decided to move back to California about 2 or 3 months ago. So I've been doing some loans here, and of course the fires happened. And
were you here when the fires occurred?
No, I wasn't here yet, but the fires here in LA have created a huge need for construction loans and probably land loans as well. And I think Arixa will be busy doing those loans, as well as the other big players in that same space. But there's going to be so much need. I don't think any one company can fill the need. So I think that over the next 5 to 7 years, making loans to builders who are building in the fire zones is probably going to be an opportunity to grow this business to to some meaningful scale. Again, I don't know exactly how big, but big enough for what I'm trying to do.
Now, did you move back? Were you moving back anyway, or was it because of the fires you saw that there would be an opportunity and a need for private credit?
I was moving back anyway because the family reasons to be in North Carolina were no longer necessary.
Yeah.
And so my wife preferred to be here. She's made a lot of friends here. And so we came back, and the fires had happened. And, it occurred to me pretty early on that the rebuild is going to be 5 to 10 year thing, probably more like 10. And there's going to be a need for good lenders that know how to do these types of loans. And this is exactly the type of loans that we've been doing for 15 years that I've been doing. So Arixa had made quite a few loans in the Palisades. Interestingly, very few, they didn't suffer too many homes that were burned down they had made loans on, but they had made quite a lot of loans in these same areas.
Well, it's before I get into this topic, I have to ask a very pressing question since you were in North Carolina.
Yeah.
Have you watched Outer Banks? Because we're a little late to the party. I don't know if you know that show.
I don't know.
Oh, it's on Netflix. A little plug for Outer Banks. My family and I are now watching Outer Banks, and it's basically like a modern version of Goonies, but set in the Outer Banks of North Carolina, where there's a bit of a treasure hunt. And
I'll check it out.
Yeah,
I did visit both Asheville and the coast of North Carolina once we arrived there, and it's just an incredible state. I mean, it's almost like what California has. They have it as well on the East Coast, but the coast is very different there, as you may know. And
only because of the show.
That's a whole separate topic,
Yeah.
but there is a huge amount of coastline in North Carolina, almost as much as California because of all the inlets.
Right.
And so it's not the way it is here where, it's extremely expensive to be at the coast. That's not the case in North Carolina. In fact, some of the poorest areas of the state are at the coast.
Yeah, the show talks about that. All right. Enough about Outer Banks, but go watch the show.
Okay.
So earlier, I like how you're taking a note. Literally just before you arrived, I was on a call with a developer talking about a strategy with respect to the Pacific Palisades. I also indicated to him that I have multiple clients who are raising funds to buy lots and develop homes in Altadena. I'm sure we will see that in the Palisades as well. There's a lot of fluidity in both communities in terms of the opportunities. There's almost no price discovery in terms of lot value, where it seemingly keeps coming down as the number of lots are increasing on the market. Construction costs are all over the place. Some people are saying it can be north of $1,000 a foot. Others are saying that's crazy. It should be $500 a foot. Maybe it's somewhere in between. Obviously, the Palisades will have a different price point than Altadena. Mm-hmm. Nobody really knows what the demand will be after the fact. People are saying the Palisades will be the best neighborhood in the country. It'll be a brand new neighborhood. It's still, near the coast, on top of a hillside, with great surrounding communities. So this whole prelude to my question is, how do you feel comfortable lending in a market where there are so many unknowns? Or are you just assuming the Palisades that you're lending to has the track record of the last several decades, and despite the fires, you feel confident that the demand and the pricing will be there?
Wow, that's a complex question. Yeah. So
and you have to answer it in 30 seconds or less.
In short, I've spent most of my real estate career, all my real estate career, living in Los Angeles, other than these last 2 years. And in a way, I feel like this is my calling. I'm 58, and this is what I know how to do. And I have a role to play, which is, it may be a small role, but I can help in a small way. And I am a huge believer in Los Angeles area. I do think these areas will be some of the best places to live once they are rebuilt for a lot of different reasons. But it's going to be bumpy getting there. And one of the challenges that you didn't mention is the cost of doing the utilities properly, undergrounding. Is that going to lead to, is the city going to have the budget to pay for that, or is it going to be borne by the neighborhood? In which case, your tax bill, and as you know, because I know that you lost your home, are you going to have a special assessment on your tax bill, which is this is the cost of the utilities that you have to pay the interest on the bond that was issued specifically for that, just within your neighborhood.
By the way, one other thing we haven't talked about, the cost of insurance.
Right. No, but I think when they rebuild in a fire resistant way, I think insurance will be more available in those areas than it is in all the areas that didn't burn, right?
That is definitely
Brentwood.
That is definitely seeing things half full and being optimistic. And so we'll see. I know Rick Caruso has been interviewed saying, look, it is going to be so expensive to require residential development to have fire resistant materials.
Right. Yeah, I mean, I think though that in the planning for the rebuild, I'm assuming there's going to be more fire resistance built into the larger system, whether that's reservoirs and that are rebuilt or whatever it is.
Yeah. Anyway, I cut you off.
Yeah, it's I'm just a believer that the area is going to recover, and we're lending typically 75% of cost, which works out to about 60% of the value of the property. So we're not the ones who are taking the risk. We're not the developers like your clients who are out there, putting their dollars down and being in first loss position. So I feel like one of the things I really enjoyed about my career in lending so far is that we can afford to take some chances on some relatively new things. And we did, because even if it doesn't turn out to be a very profitable investment for the borrower, we can still get paid off and make a return on the loan. And so why not support things that are trying to innovate, that are trying to do something a little different? For example, we did some manufactured housing in LA where it was sort of built in a factory and then brought and assembled on site. And, those loans were a little tricky to figure out, but we want anything that brings the cost down is needed. And we've got to try to support that, right? We've got to try to do those things. So I would put this in the same category. Yes, there's some risk. Yes, there's environmental questions and all kinds of other questions that you raised, but we're not taking as much risk as the developer. So why not step up and try hard to be there and support the rebuild? Because even though we're only going to be able to lend to professional builders and developers, not owner occupants that are rebuilding, that's a consumer loan, can't do that. We're not set up to do that. But every house that gets built is going to help with the rebuild. Every time a house gets built, it's going to be a little bit closer to back as a functioning neighborhood, right? And I think the developers are going to move, some of them are going to move pretty quickly and test the market. And they may not sell for exactly what they hope to, but it would take a lot for us to actually lose money on the loan.
Do you have an opinion as to what you think construction costs will be?
I've heard the same range that you have. Yeah. I think it depends on if you're able to order in bulk, like some of the biggest builders will, and your costs could be down probably in the 600s, my guess. And if you're an owner occupant that's getting a bid to rebuild a house, you're almost certainly going to be offered 1,000 a square foot or more, right?
Do you have a concern though, when you were doing loans in the Palisades or any other neighborhood, and maybe there were only one or two construction projects on the block of 25 to 50 homes, and now you're lending money to a developer who's building, and it's 5,000 to 6,000 homes that are trying to get built around the same time, and that your money will be out there for a lot longer period than what it would have been pre-fire, just because of the logistics of getting in and out and the time it will take to build a home?
I don't know. I think the city is trying hard, and probably the county and Altadena, to remove the obstacles from getting a building permit and make it easier to get a permit. And it wasn't easy to get a permit before. Remember, before the fires, if you wanted to build a house in Palisades, that was a hard project. And I think it's still going to be a hard project. And there are some new obstacles, but in some ways, I think the city's going to try to give you your permits a little faster now.
But even after that, so you got your permits.
Yeah. To actually build.
Just to actually build, and the logistical traffic issues, the ingress egress of in and out of the Palisades, of getting cement and wood and all the materials that one needs, not just to build one house, but thousands.
Yeah. So I mean, I need to learn more. I'm pretty new to the scene, and I want to start talking to some of the same people you've been interviewing and understanding what those challenges are and understanding how is this really going to work. Again, back to life's calling. This is something, my career has been in lending. I love doing it. I hope to do it another 20 years. We did 1,800 loans while I was running Arixa, and I'm hoping I can do another 1,800. That would be a great career to me. I need to learn and get smart about these things and then figure out how can we earn a reasonable return as a lender to some of these developers without taking excessive risk. But I need to talk to a lot more people to get smart about how to do it. I still think, though, that if you're working with really expert builders, you can leverage their expertise a lot. They're putting their money in the first loss position, right? They're putting in 25% of the project cost in cash up front with fresh cash. And if you're working with smart borrowers, you probably are not going to get hurt as the lender. Sure. Smart and of high character, which is what we were fortunate to do most of the time.
Are you able to talk about what the interest rate will likely be?
Well, I think let's go back to what are private credit investors demanding today, right? Sure. And we're here a few blocks away from Ares, which is one of the biggest private credit companies in the world, more than $100 billion of private credit investments. My guess is they have something available for high net worth investors that's paying 10%. I'm almost sure they do. And it's maybe an open-ended fund, maybe a closed-end fund. I'm not exactly sure of that. Now, that's not real estate loans. That is loans to companies that are private equity backed. And so I don't think we have to hit exactly the same net return that they hit, because I think people realize when you're doing real estate loans, you have bricks and mortar, and our fund is not going to only do the Palisades. We haven't done any loans in the fire zones yet. We've done about 18 loans of all kinds of, bridge renovation, construction loans in the Durham, North Carolina area, and a few around Southern California. So I think we have to hit it between a 9 and 10% net return. And that probably means the rates are in the low 10s for some of these loans. Maybe high 9s can work if you use a little bit of leverage, structural leverage, although we're not going to be using much structural leverage for this next period of time, just a little bit to kind of manage cash drag. And then there's going to be an origination fee, which is probably, depending on the maturity of the loan, between 1 and 2 points.
What about the recourse? Obviously, a completion guarantee, but how do you handle personal recourse on your loans?
Yeah, so I have tended to focus on the smaller builders that are just people that I really like, and not the large builders who tend to be most concerned about recourse. So the vast majority of loans I've done have been recourse loans, and most of the time the borrower doesn't strongly object, because their feeling is, look, I'm putting in X dollars, I'm planning to get that back plus a profit of Y. Guaranteeing this loan, which is 75% of my cost, 60% of the value, isn't really risky for me, because the real risk for them is the money, the cash that they're putting in. So most of our loans have been recourse, and I've done construction loans where it was limited recourse with a completion guarantee, or partial recourse, or bad boy carve outs. Those things are out there, but it's kind of case by case. But generally speaking, I'm not looking to fund the people that are going to be doing 100 projects. I'm funding people that are maybe going to do 1 or 2 or 3 a year most of the time.
Now, you mentioned getting financing for your own loans, right? And that you'll likely have low leverage. A variety of debt funds utilize leverage in order to boost their returns, but they also come with risk.
Yes.
And oftentimes when those lenders are overly levered themselves, that's when problems surface.
Yep.
So talk about why you're electing to have a lower leverage debt fund yourself, and just the opportunities that are out there. Because we, at our firm at Kirsh, we form a lot of debt funds, and we talk to our clients a lot about the types of financing that's available to them.
Mhm.
But it's not widely known in the public about the types of, note-on-note financing, warehouse lines, and things of that nature. So if you're able to educate our audience about that.
Well, it's a deep topic. It's a topic for a separate podcast probably, or a separate conversation. But there are warehouse lines of credit available for lenders that do the kind of work that we do. The cost of that capital is much higher than it was 3 years ago because everything has gone up. Interest rates have gone up. So, you're probably paying in our industry in the 8s today on your line of credit. And to me, that's one of the reasons I don't want to use too much leverage, is because that's a pretty high cost of capital. And it's helpful to have a line of credit if you're doing construction loans, because you have these constant outflows of construction draws, and then you have these inflows when loans pay off. So in order to manage your cash, having an accordion part of your balance sheet that can grow or shrink is very useful. And that's where the bank lines of credit and non-bank lines of credit can be great. But using structural leverage is one of the tools in the toolbox. But for this current vehicle, we're partly because one of our early investors is a little bit averse to too much structural leverage. We're trying to see if we can build a fund with a little bit of structural leverage, but not much. And it does enhance returns, but the people that are investing in the funds that I manage are pretty risk averse generally and looking for just steady income and capital preservation. So using some structural leverage, but not too much, felt like the right move for this fund.
So you're an entrepreneur. You've started, multiple businesses. You're starting Sage. Now, do you spend more time fundraising for Sage, or more time originating loans?
Well, so one of the reasons this business is the right fit for me is that I can do both, and I enjoy doing both. And when in any given room I'm in, there's usually one person in the room who's either a potential borrower or potential investor, or knows somebody who would be a potential borrower or investor. So I feel like I'm there to be of service. I know that might sound a little odd, but if something that I'm doing is helpful, I want to do that. And whether that's telling them about a fund that they may want to invest in, or telling them about the loans that we do if they're doing projects themselves. So I would say I'm probably spending equal time on both right now. Yeah. And I have a small team, and I'm also spending time training them, because over time I want them to be able to handle almost all the day-to-day operations of the business. And I want to be able to just focus on being the chief investment officer and portfolio manager, and then bring in potential new clients of the fund, through my network.
Yeah. So compare the market that we're in today versus the market when you were starting Arixa, and maybe not the 06 timeframe, because that was the height of the real estate market before the GFC, but coming out of the GFC, the 2009, 10, 11 time period versus today. What are the differences in starting your company now versus 15 years ago?
Yeah, well, first of all, there is much more competition of other lenders doing the kinds of loans we do. But as a group, I think that they're all a little capital constrained, actually, because it's very hard to raise money. And the reason it's hard to raise money is all kinds of reasons. But, that investors have more options to get an 8, 9, 10% annual yield in private credit. They have many more options than they had when I started that. So I think the big theme is it is much, much, much more competitive, both on the capital raising side and with borrowers to make loans. At the same time, the opportunity remains enormous. And there's a need for lenders to fill this void. And for example, the fire zones, no one company, even the biggest one, they can't build an entire portfolio just in the fire zones, because investors don't want that, right? So all of us are going to have to put as much as we can into that market, but it's still going to be limited in terms of how much we can put into that market, right? I'm much better at doing this now. I have a formula that I worked out with my partner's help, Greg Hebner at Arixa, that I think it really works well to take care of borrowers and treat them like VIPs. And figure out which loans to make and avoid the bad ones. So, I have a lot more experience, and I have a track record too. And I think I'm proud of the track record we developed at Arixa of making money consistently for investors. So I would say overall, it's more competitive, which makes it harder, but I'm much better at it and know how to do it and know how to pick the right talent now to do it. So it's kind of similar. I'm really going back to exactly where I was, in a way, where I was 15 years ago. I'm just starting over, starting small, and just trying to find good borrowers, make good loans, and have investors that are looking for what we have to offer and make sure that they're really on board with how we're doing it, and enjoy the process. So
yeah. Now, on the investor side, you're going up 75% of cost, 60% of value. Do you get pushback from investors who have invested in preferred equity and say, I can get a much juicier return, but how high up the stack do they need to go?
Anybody who has invested for a while knows that you can get higher returns for junior loans, you can get higher returns for preferred equity, and you can get higher returns for just straight equity,
Sure.
and maybe get higher returns by being the developer yourself.
Oh, of course.
But we all know that comes with more volatility. And, that's kind of an understatement, right? It comes with volatility, which includes, for all of us that have been doing this for a while, we all have investments where we lost a big part of the principal, probably, right? And that's not fun for me. I don't enjoy that. And that's why I focused on senior loans. So I think I'm finding like-minded investors who are willing to give up that explosive upside in order to have more consistent returns, sleep well at night, few foreclosures, fewer loan losses, low loan losses, a smooth ride, essentially. The people what I've found is the investors that are kind of a lot younger than me, they probably aren't going to be that interested in what I have to offer, because they want to hit home runs and they want to invest in something exciting, and being the equity investor is more exciting for them. This is not the most exciting investment strategy. What we do is private credit is designed for consistency. And so it tends to appeal to older investors, I think.
Yep. All right, last question.
Yeah.
You said you were 58, but you don't look a day over 48.
Thank you.
I get a lot of inbound calls, conversations, emails from people who are just graduating college.
Mm-hmm.
They're in their early to mid 20s.
Mm-hmm.
They want to get in the real estate business. What advice would you have for people who are starting out to enter into the real estate market, and maybe they're thinking of being on the credit side?
Well, so I have also received that same stream of inquiries from young people.
It's
great.
It's great, but then it also means we're old.
Well, yes, and we are. I mean, I'm older than you, but so I wrote up a little memo with my advice.
Oh,
and
wow.
if anybody wants to get a copy of that, hopefully Andrew can get you my contact information.
Sure.
And I welcome that. It's also on the website of our business. If you dig a little bit, you'll find it, for Sage Credit Investment Partners. And basically, the way I look at it is, when you're looking for a job in real estate, you're being a salesperson. You're trying to find someone who needs what you have to offer. So that's sales. And you want to build a network, and you want to do informational interviews, and you want to follow up and follow through with everybody. You want to get a referral. Anybody you talk to, you want to see if they can introduce you to another person so that you can expand your network. And what I found in my own career is that the job offer came when 2 or 3 people from the company had met me independently and could all vouch for me. Like, I met him. He seems like someone that could succeed here. And so if you're able to meet enough people, you're able to eventually get to, if it's a bigger company you're looking to work for, which can be a good way to start your career, you build your network to the point that there are 2 or 3 people in the room that's making the decision that can say, yep, I met him and I thought he could do the job. And you might meet those people through different parts of your network, which is ideal, actually.
Yeah.
But that means you have to work your tail off networking. You have to do 100 or 200 informational interviews, probably. So I'll leave it there, but the rest of my stuff is in the memo.
Yeah, look, I completely agree. You mentioned a couple things I just want to focus on. I was going to say double click, but I hate that phrase. I'll just say focus on. One, sales. We are all salesmen in any profession. Sales is the lifeblood of anything, right? And of any business. And AI is going to disintermediate so many industries that we all have to become even better salespeople. And I have two young kids, 10 and 8, and I've applauded my kids' school for doing as many live presentations as possible, because the one thing AI cannot replicate is your ability to stand up in front of people and communicate and speak and interact with them on a one-on-one basis. And then secondly, networking. I've told people that before I was married, and actually before I had kids, and we probably ran into each other at so many different events, right? Whether it's coffees and dinners and charity events or professional networking events, you just got to do it, and you got to expand the network. And but not just attending events and being a passenger, but being actively involved in boards and committees, so you can see the same people consistently, and that's how you build relationships.
And trying to make introductions that are mutually beneficial. That's also great if you can actually put two people together that have something that each person can get something valuable out of it. You're probably going to end up getting a referral from each of those people eventually, right?
For sure.
Which I know you've been great at. I mean, I admire how you built your business and your career, and you've been active doing things like this and the event where I met Greg and a bunch of other stuff. You just mentioned AI, so I want to close on that.
Yeah.
Real estate, private credit, and real estate investment generally is an area that I think is pretty well insulated from AI taking the jobs away. There are parts of it, of course, that will be AI enabled, but I do like our field as a place to be long term, because investing in real estate here in the U.S. is probably going to remain a relatively desirable investment. And I don't think AI can do the work that we have to do to choose the good investments and how to avoid the bad ones. I don't think AI is going to be great at that. I think it's still going to be a craft. And so learn the craft from somebody that you really admire, that's good at it, like I did from Sam, going back full circle. He's a good investor for the most part. And I think he'll be okay.
Yeah. Well, look, Jan, first, thank you for coming in. Thanks for being on the podcast. You are one of the true professionals in our industry, good, decent people. And I know that Sage Capital is going to be extremely successful. Let me say the full name, Sage Credit Investment Partners. And just best of luck to you, to the family, to your new company, and to what you're going to be doing in fire victim areas.
Yeah,
so
we'll be talking. Thank you for everything you do as well. Appreciate it, Andrew.
Thanks, man. Take care.
Take care.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing this show with others.